Welcome back to Crypto Unlocked. I'm your host, Crypto Daryl. When the headlines hit, it felt like deja vu. Every trader who thought the market had finally reached stability, a single geopolitical move from the United States detonated a chain reaction across global markets, and crypto took the brunt of that blast. Late last night, President Trump announced sweeping 100% tariffs on Chinese technology exports, along with fresh restrictions on critical software components. Within minutes, the future markets went red. Risk assets sold off, and over $19 billion in leveraged crypto positions were liquidated in what analysts are already calling the largest single-day wipeout in the history of digital assets. Bitcoin plunged nearly $10,000 in less than an hour. Ethereum followed, and the rest of the altcoin board looked like a crime scene of cascading liquidations. Order books evaporated, liquidation engines kicked in, and exchanges everywhere reported record volume as traders scrambled to de-risk. But in the chaos, something interesting has happened. This time, the institutions didn't flinch. While retail traders were getting liquidated, institutional desks were quietly buying the dip. That's the new phase we're in. Bitcoin isn't just a speculative asset anymore. It's become a macro instrument that reacts to global policy, just like gold, oil, and treasuries. When tariffs, wars, or inflation shock hits, it's not just crypto degens trading charts. It's sovereign funds, hedge funds, and publicly listed companies adjusting their exposure. And despite that historical sell-off, within 48 hours, Bitcoin didn't just recover, it made history. It broke through $125,000 for the first time ever, setting a brand new all-time high, fueled by unprecedented ETF inflows. According to on-chain analytics, over $5.9 billion poured into crypto ETFs in a single week. $3.5 billion of that was Bitcoin alone. What we just witnessed was the largest transfer of Bitcoin ownership from over-leveraged retail speculators to patient institutional investors in modern-day history. They used fear to accumulate, and they did it in size. If you zoom out, you can see the bigger story unfolding. The tariff shock didn't break Bitcoin, it revealed Bitcoin's new identity. Every time governments weaponize trade, every time fiat systems bend under political pressure, Bitcoin quietly gains more legitimacy as a neutral settlement layer for the world. While the headlines framed it as a crash, it was really a liquidity rotation. The weak hands flushed out and the deep-pocketed buyers stepped in. On the charts, it looked violent, but under the surface, it was the most bullish kind of volatility you could ask for. Forced sellers meeting infinite demand. This is how new price floors are born. Every major liquidation cascade in Bitcoin's history has preceded a massive rally once the leverage clears. In 2020, it was the COVID crash. In 2022, it was FTX collapse. In 2025, it's the tariff shock. And each time, Bitcoin came back stronger because its fundamentals don't rely on political stability. They thrive on instability. The record high ETF inflows prove that the big money doesn't care about the short-term noise. They care about the exposure. BlackRock, Fidelity, and Franklin Templeton have turned Bitcoin from a fringe trade into an asset class sitting beside gold on institutional balance sheets. These entities aren't flipping coins. They're allocating capital for decades. When they buy, they lock supply. And when the free float dries up, price discovery gets explosive. You can already see the data. Exchange reserves are at a 5-year low. Miners are holding instead of selling, and whales are moving coins into cold storage. The same week retail panicked, over 100,000 Bitcoin left centralized exchanges. That's institutional absorption at work. This moment also highlights why leverage is both the best and the worst thing in crypto. Leverage amplifies conviction when you're right and obliterates you when macro events shift the narrative overnight. $19 billion in liquidations is not just a statistic. It's the emotional reset that clears the path for the new leg up. Once the over-leveraged traders are gone, markets can finally breathe. It's like pruning a tree, painful but necessary for new growth. And Bitcoin's bounce back above 125,000 is just proof of the resilience that few assets can match. Traditional markets took weeks to recover from tariff news. Bitcoin did it in 48 hours. Now, the conversation isn't about whether Bitcoin survives global shocks, it's how it thrives on them. Every time a government interferes with free trade, Bitcoin's narrative strengthens. Borderless, permissionless, and censorship-resistant money for a digital world. The irony is almost poetic. Political attempts to control global commerce are fueling the demand for an asset designed to exist outside that control. Institutions understand this. That's why ETF inflows spike right after macro tension. They see Bitcoin the way gold was once seen, the insurance policy against the chaos. Only difference is Bitcoin moves faster, stores better, and lives on the internet. The altcoin market felt the tremors too. Ethereum briefly slipped under the 3,500, and Solana lost 20% in under an hour. Quant and Chainlink both retraced before snapping back once Bitcoin stabilized. But here's the interesting takeaway. The altcoin recovery lagged while Bitcoin dominance surged to a new cycle high. That tells you where the big capital is flowing right now, back to the king. Institutions don't start with altcoins, they start with Bitcoin exposure. Once they're comfortable, they trickle down to infrastructure plays like Quant or Link or Sol. So this volatility isn't the end of the alt season. It's the warm-up act. The liquidity first concentrates in Bitcoin, builds trust, then spreads outward. On-chain analysts also reveal something remarkable. Retail investors sold heavily during the tariff panic, but the wallet data shows that addresses holding between 10 and 100 Bitcoin, the mid-tier people, actually increased their holdings. That means small institutions, family offices, and high net worth individuals are quietly dollar cost averaging through the chaos. The same pattern repeated in every cycle. Fear creates the discount. Conviction creates wealth. Macro context matters too. Tariffs and trade wars are inflationary by design. They raise costs, constrain supply chains, and pressure centralized banks to print more money to stabilize domestic economies. Every such cycle reinforces Bitcoin's purpose as a hedge against monetary manipulation. It's not about politics, it's about math. Fiat supply expands, Bitcoin supply doesn't. Fiat value erodes, Bitcoin scarcity compounds. That's why geopolitical disruption eventually becomes a bullish narrative for digital assets. It's not wishful thinking, it's structural economics. From a psychological standpoint, this event separates traders from investors. Traders saw red candles, investors saw opportunity. Traders chased liquidation reversals, investors bought long-term security. And that's what defines a mature market, when short-term panic creates long-term conviction. The institutions aren't emotional because they see the data. They know the data. They've modeled these shocks. They've seen every crash, and they know the direction of capital flow doesn't reverse easily once it starts. ETF volume alone is reshaping how the asset trades. Less volatility per unit of demand, higher price stability, and more mainstream credibility. Each new high is no longer retail euphoria, it's structural inflow. The old cycles of hype and despair are giving way to cycles of adoption and integration. That's the new era we're entering into, the institutionalization of digital assets. So when you look back at this so-called crash, remember what really happened. $19 billion in leverage didn't destroy the market, it cleansed it. Tariffs didn't break Bitcoin, they validated it. And the price action that followed didn't just set a new record, it confirmed a new paradigm. Bitcoin has evolved from speculation to infrastructure, from volatility to resilience, from outsider asset to global reserve contender. Every panic now is simply another opportunity for accumulation by those who understand the macro game. The lesson is simple here. When the world shakes, strong hands buy. Institutions don't chase headlines, they accumulate through them. This moment, the biggest liquidation ever, has been followed up by the biggest institutional inflow ever. And it also marks the next great Bitcoin cycle. Before we wrap this up though, let's talk about where you trade during all this volatility, because surviving these swings is just as important as spotting them. When markets move this fast, you can't afford lag, frozen charts, or random liquidation glitches. That's exactly why I traded with BTCC exchange. They've been around since 2011, longer than most have been in business. And they're still operating till this day. Through every bull market, every bear market, and regulatory wave, that kind of longevity only comes with trust and reliability. You can also trade Bitcoin, Ethereum, XDC, and a wide range of altcoins with fast execution, deep liquidity, and some of the lowest trading fees in the game. Plus, if you use my link down below, you'll also get 10% off of all trading fees permanently, meaning more of the profits stay where they need to belong, which is in your pocket, not on exchanges. So if you're serious about taking your trading game to the next level or to the next phase of this market, whether it's volatility from tariffs, ETF inflows, or the next macro shock, make sure you're trading on the platform that is built to handle it. Hit the link down below and lock in your 10% discount and start trading smarter with BTCC Exchange, where reliability meets precision in every single trade. Thank you so much, and I'll see you next week.